I want to circle back just to the interest rates for a minute and talk about as we see rates or when we see rates start to come down, how that may impact investments, and what we how we do asset allocation in client portfolios. And we've talked about this several times in other calls, but I think it's always worth reviewing. So as interest rates comes down, it cuts both ways, right? It cut in terms of what we would have to pay for a mortgage or other debts. That interest rate also tends to come down. But then what we're earning on our fixed income investments also comes down. And so as we're looking at, the potential for interest rates to come down this year, how that impacts the types of investments that we're owning for clients. I mean, from the sort of the most easily impacted and viewed the investment being a money market position, which is very correlated to the Fed funds rate. We'll start to see the interest rate on our money market positions come down. We'll also see the interest rate on what we can get for the interest rate that we can get on corporate bonds and other types of bonds will start to come down as well. So as we're looking across fixed income investments, as we see rates coming down, we'll also see the interest we can earn on those types of investments coming down. Okay, so moving on from interest rates, it probably surprises no one that 2024 is an election year, and we've already been hearing quite a bit about that. How does an election year impact the markets? Does it matter, what party is in power in terms of how well the markets perform? Without getting too political, just kind of want to share some information on, what do we see in an election year in general, how it impacts the markets, if at all.
Yeah, I'll jump in on that. Great question, timely question. We like to say don't mix portfolios and politics. Not only can it lead to suboptimal decision making based on passion and emotion, but the fact is the outcome of any given election in any given year just simply doesn't matter much to the stock market. Typically, the person sitting in the White House, and I've said this many times before, the person sitting in the White House gets too much credit when things go right and too much blame when they go wrong. That's typically kind of just how it goes. Instead, millions of daily decisions, the vast majority of which, by the way, are apolitical, repeated over and over by consumers, businesses, and investors. Those are the things that determine where the economy goes, what business profits look like, and the valuation multiple placed on stocks. In some years, this all works to reduce stock prices, like we saw in 2022. In most years, these things are a tailwind. In fact, history shows that in most years, roughly 3 out of 4, they're a benefit to stock prices. They move in the right direction. And election years are no different, with most of them being directionally positive. And you can go back, over 40 years, 50 years, 100 years, and look at stock market returns in election years. And the average is a little bit lower than the long run average, but it's not lower by much. Finally, I would make the point, that's the macro view. I want to make the point about the micro view. Good companies don't really care who's in the White House or what tilt makes up Congress. At the margin, it can certainly have an impact. But in our analytical model, we just ask a simple question of does the person who occupies 1600 Pennsylvania Avenue really have a material long-term impact on the earnings and cash flows of Apple or Microsoft or Costco? And we can certainly create extreme scenarios where it could, but probabilistically, which is the soup we swim in as investors, history is quite clear on the answer, and that answer is no. Good companies survive and thrive based on the products and services they sell, how they allocate capital, invest, how they manage their resources. I mean, that's 99% of the ball game when you're looking for good investments. It's why Google stock is up over 5,000% since going public 20 years ago, despite 5 presidential elections and 4 different sitting presidents, not to mention midterm elections and local elections and more. So it just doesn't really matter to strong businesses. So that's how we frame election years with markets and portfolios, is just ignore the noise, own good companies, own good investments, and think and act long term.
Right. To paraphrase several others who have used this in a different context, What do you get when you mix politics and investing? You get politics. So we have to keep it separate. And we have to focus on, as Jason said, what are the companies we own? What are they doing? How are they treating their customers, their consumers, their suppliers? And are they likely to continue to thrive and prosper? And that has to be the basis of our investment work.